Good morning and hello, clients and friends. This is Craig Llewellyn from U.S. Investors International, and it's my pleasure to present our fourth quarter economic review and 2024 outlook. Uh, at our firm, we partner with clients and believe an educated client is our best client. And while we always try our best to help you when it comes to your finances, we believe that knowledge is power. And one of our missions is to share with clients any knowledge that can better help you make a more informed decision. So let's get into the fourth quarter and kind of what happened here, especially late into it. So 2023 is in the books, and the year's final quarter left investors looking forward to a bright and happy new year. Historically, equities typically have advanced in the fourth quarter, and we can now add 2023 to that statistic. And that usually happens after we've had a third quarter like we did when we got hammered pretty good. So in November, December, stocks surged. It raced a tough October to finish the quarter sharply higher. The last 2 months of the quarter, including the Dow Jones Industrial Average breaking a record and the S&P 500 advancing for 9 straight weeks. Thanks to the strong year end, the S&P 500 and the Dow ended up very strong, and the Dow was up more than 13%. And the year-end jump was attributed primarily to the Federal Reserve signaling they are ready to pivot from their aggressive monetary position and now are indicating that interest rates could be cut several times in 2024. Inflation pressures continued to ease in the fourth quarter. In October, the 12-month percentage change in all items in the Consumer Price Index decreased to 3.2%, following gains of approximately 3.7% in August and September. In November, the slowing trend continued, clocking in at 3.1% increase compared to a year earlier. It's important to know in the last few weeks that in the beginning of this year, the inflation number actually jumped back up to 3.4%. We're hoping that was just a seasonality situation, but the next couple, 3 months are going to tell us if we're still cooling in inflation or what's happening there. But while we've seen a significant improvement from the 9.1% peak in June of 2022, there's clearly still a lot of way to go to reach the Federal Reserve's target of 2%. The Fed did not raise interest rates in the fourth quarter, and they remained in the target range of 5.25 to 5.50%. During the Fed's December meeting, it was also indicated that we could see several rate cuts in 2024. So the Fed has raised interest rates a whopping 11 times since March of 2022. So no changes to rates 3 times in a row, and the possibility of a near-term future rate cut was well received at the end of the year. So this year there are 8 FOMC meetings in 2024, and although it is currently anticipated that rates will go down, the Fed remains committed to achieving the 2% inflation rate goal and intends to adjust rates accordingly should inflation pressures have a resurgence. So why is this important? So some of you may or may not know, bonds and interest rates move in the opposite direction of each other. While interest rates rise, existing bond prices tend to fall, and conversely, when interest rates decline, existing bond prices tend to rise. So we saw 2 years ago, we saw interest rates rise and bonds fall. Now the idea that rates may come down at the end of the year, we had a year-end surge in bond prices, which were down for most of 2023, had a historic rally, and after 2 straight years of losses, bond investors saw a positive year-end. The sudden pivot in bonds is testament to the volatility we saw in 2023. It also reminds us how much weight that the Fed movements carry. As of December 29, 2023, 5-year Treasury notes yielded 3.84%, 10-year notes yielded 3.88%, 20-year notes yielded 4.2%, and 30-year notes reached 4.03%. The 20-year Treasury note yielded as high as 5.3% on October 19, 2023. We will continue to closely monitor how the Fed's movement in interest rates are affecting bond yields, and with the Fed's anticipating rate cuts in 2024, this may narrow the opportunity to get lower risk, high yielding bonds, which we've been enjoying the last couple of years. But safety comes with a cost, and even though interest rates have risen, many major banks are still averaging low interest rates to savers. As you can see here, according to Barron's, the average bank money market rates on December 29, 2023 were still only 0.6%, and the average 12-month CD rate was 1.94%. They have increased significantly in the last 12 months. However, savers are still seeing lower returns. So if you want to explore, if you're interested in exploring better interest rates, please contact us. I've been talking to a lot of you about this already, a lot of different options. The banks have not kept up with some of the online banks and what we can do as well. So recession fears have overall significantly diminished. Many analysts believe that real GDP growth will regress but remain healthy, and the labor market will remain strong. They also anticipate that inflation will continue to lose steam and will decline to 2.5% in 2024. The key indicators show signs of a soft landing or a shallow recession, if any, appears to be more possible. And again, next 2 or 3 months will tell us more if we're on track for that. We turn to the global economy, which continued to be in an uncertain position in the fourth quarter. Geopolitical unrest was heightened with conflict in the Middle East and the ongoing Russia-Ukraine war. Tensions with China continue to remain a concern in the new year. Interesting, the last few days ago, Taiwan had their elections. The man that China wanted did not win, so this could be very interesting as we move through this year. Anytime uncertainty within geopolitical issues are key fear for equities, and we will continue to keep an eye on how they may affect the equity markets. In any given year, there's always a 20% of a geopolitical event. Those are things we don't see coming. But equity markets surprised most analysts in 2023 and rewarded our focus of being disciplined with our long-term equity investments. But remember, as we enter 2024, our continued mantra, proceed with caution. Although we enter 2024 with hope and optimism, equity investments should be viewed with a long-term lens, and short-term movements are still always unpredictable. So now is a good time to review your investments and confirm they are still congruent with your time horizon, risk tolerance, and goals. We've been doing much of that here year to date. I've been talking to many of you so far beginning of this year, and we've been rebalancing and taking profits, and we'll continue to do that as the year moves on. Regardless of what 2024 will bring, it is always prudent to watch your expenses and make smart money investment decisions. And we believe in proactive preparation, and our goal is to provide our clients with solid financial strategy that is carefully designed to withstand any market environment. Long-term strategy should always be the benchmark for smart investors. So getting out of debt, making sure our cash reserves are plentiful is going to be a major theme this year. So let's recap. A healthy quarter four. Here are some things to remember. Again, inflation is getting closer to the Fed's goal of 2%, but still elevated at 3.1% as of November. As of January, it ticked up to 3.4. Again, we're hoping that's due to the season. Again, the next 2 or 3 months will tell us more. News of possible interest rate cuts in 2024 have brought a sigh of relief for many. The question is, are we going to get as many as they're predicting, or fewer? Again, the next 2 or 3 months will tell us more on that as the numbers come through. Volatility will remain. Remember, a well-balanced portfolio should be designed to have resilience in times of volatility. Economists are currently saying we are more likely to experience a soft landing instead of a major recession. You're hearing that more and more. Stay in the course and maintain the consistency of a well-devised, long-term focused plan has historically served investors well. While 2023 was a good year, this is not a time to throw caution to the wind. As investment professionals, we will still be prepared, and recent history has shown us that anything can happen. So once again, proceeding with caution should still be the principal notion for investors. We help create well-crafted strategies and plans that are customized for your unique situation and goals, and having a solid plan includes consistency, considering your time horizon, tax implications, liquidity needs, risk tolerance, and overall personal objectives. If you have any questions about your personal situation, please call us. I've been talking to many of you. I'll continue to do that as we move forward with our reviews. We are very grateful for you and appreciate the opportunity to partner with you in your financial journey. One of our goals is to help more people just like you. The best compliment is an introduction. Some of our best clients are were referred to us by existing clients. If you know anyone that you may think will benefit from our services, we would appreciate if you shared this video. Also, the quarterly report that was just sent to you, the fourth quarter report, I get a lot of good feedback on that. A lot of time goes into that. If other people are nervous, please share this information with them. And we would be honored if you provided us with their contact information so we can add them to our distribution list, receive our newsletters, and invite them to watch and attend our presentations. And that's true too for the workshops that we have. We usually do 3 to 4 workshops a year. The next one's coming up at the end of February. We're going to go over the economy. We're going to talk more on the economy, what we're seeing. We're also going to look at the tax situation, getting an update on where we're at on taxes. The great tax sunset is coming. A lot of things you should know it's going to impact all of us. This meeting late February, those invites will be coming out to you shortly. Everybody should be coming to that. Again, thank you for your faith in us. One of our primary goals is to keep clients informed, and we appreciate you watching this update. Please call us if you have any questions.